So for now, as I was saying, I want to finish something that I guess is a loose thread from before. Remember, on Monday we were talking about bank capital. And an issue with bank capital, which came up in the exit quiz, was that bank capital is something that, even though it's a good thing to have because it cushions your bank against losses to the value of your assets, it's actually something that the owners themselves are maybe unwilling to provide. One way to see that was when the bank is actually insolvent. If you add bank capital at that point, of course, that money is going to somebody else directly because they're making sure that you can meet your other obligations. But there is a broader sense in which bank capital is costly to the owners, and that's what I wanted to discuss briefly before we move on to our main topic, which is liquidity management. So here's a balance sheet, and the main source of funds is deposits. Let's write bank capital here. And there is some total, and of course the total of the assets has to be the same because there is only one pile of funds. There's no such thing as a separate pile of liabilities and a separate pile of assets. And here are a bunch of assets. Let's not worry about what they are. Suffice to say that, of course, a big part of the bank's life, aside from capital management that we talked about on Monday and liquidity management that we'll talk about today, another of its activities is asset management. Which is trying to figure out which securities and which loans are the ones that it can make in order to generate the greatest profits. So if you give a bank an additional dollar, it's going to use it as best it can in terms of securities and loans and so on. And in that way, it's going to generate a certain amount of profits, and so the profit per dollar that the bank can make is referred to as the return on assets, or ROA. Right? So if you give the bank an additional dollar, it's going to invest it in whatever it thinks is the best way, and it'll generate some return on assets, which of course is the total return divided by the total assets. But that's not necessarily what the owners are interested in. The owner's stake here is just the bank capital. So what they care about isn't the return on assets, it's the return on each dollar that they have invested in the bank, which is the return on capital, or ROC. Now, of course, there's a link between the return on assets and the return on capital. And what's the link? Well, the return on assets is total return divided by assets. The return on capital is the total return divided by the capital. If you look at this carefully, you'll see that the return on capital is the same thing, since we can rearrange this top equation to say the total return equals the return on assets times total assets divided by the bank capital. So what happens here if you ask the owners to please put in $1 more of bank capital? The capital will go up by 1. Of course, the total will go up by 1. And, well, once the bank has had time to figure out what's the best use of this dollar, the assets will go up by 1, and they'll earn the return on assets. Now, if you add 1, now what happens to the return on capital? Well, we're adding 1 to the capital, we're adding 1 to the assets. The problem is, capital is a much smaller number than the assets. So when you add 1 to both of them, you're making this number bigger. This number is also getting bigger, but as a proportion, it's a much smaller amount. So when you add capital, what you're mainly doing is making the denominator larger. The assets are getting larger, but by a smaller proportion. So the numerator doesn't change much, the denominator increases, and so what happens to the return on capital overall? It goes down. And that's why bank owners may be reluctant to increase capital. It's directly lowering the thing that they care about, which is the return on capital, because it's the return on assets isn't going to be very effective, right? The bank's still going to do as good a job as it can there, but you're raising the capital more and you're raising the assets. That +1 here is a much bigger share than the +1 up on top. All right? So that is a fuller explanation for why it is that bank owners don't necessarily want to add more capital into the bank, which is a problem, right? Because of course we want more bank capital to keep the bank safe, but it's costly to the owners, dilutes their returns. So they're generally going to be reluctant to do that. All right, so that's the full explanation. Any questions, comments, thoughts about bank capital before we move on to the next topic? All right, if not, then let's clean the board. Oops. And move on to today's main topic, which is liquidity management. There. So what's liquidity? Well, liquidity is money. Liquidity is the ease of turning something into money, or more broadly, the ease of making payments. And that's what liquidity management is. It's the idea that banks need to ensure that they can make any payments that they're obligated to do. And of course, anytime we say something about obligations, what it means is we're probably talking about liabilities. So these are the liabilities of the bank: deposits, borrowings, and capital. So what payments might the bank need to make to its depositors? Well, it might be that you go up to an ATM machine and withdraw some cash. They would have to make sure that they have the cash to give any customers that want to do that. Alternatively, you might go on to Amazon.com and buy a new webcam with your debit card. Then the bank needs to make sure that it has in this case, not actual cash on hand, but some form of electronic money to be able to make that payment that you requested. So that's one reason, right? You have your funds in deposits at the bank, and the bank needs to have something on hand in order to be able to make payments to you when you request them. What about borrowings? Well, to the extent that the bank has any borrowings, it has to pay interest or repay the loans. So they'll need to have some kind of asset that they can use to make those payments. What about bank capital? Well, these are the funds of the owners, and every now and then they will have to distribute the return on assets, or return on capital rather, that we discussed, right? These would be dividend payments. So in all cases, the bank would need something that it can give each of these customers when needed. In other words, it has to think about exactly what form to have its assets in. Now, the main business of banks is to make loans and charge interest. And so if it ever needs to make a payment, it's going to be hard for them to do much about the loans. But the other things here on their balance sheet are securities and reserves. And what are reserves? Reserves are precisely liquid assets that the bank has on hand in order to make each of these payments. So the problem of liquidity management is the problem of making sure that you have enough reserves at every point in time. And if you find yourself with a different amount of reserves than what you want, you have to make an adjustment quickly to get back. And just like with bank capital, there's a tension here. Or at least there used to be. To the extent that if we think of reserves as being actual cash, which in this case would be known as vault cash, because it's literally sitting in a vault in the bank or an ATM machine. If we think of it literally as cash, then of course, any dollar you have in reserves is a dollar that's not generating profits for you, right? Whereas the loans and the securities are generating interest. On the other hand, just like with capital, you need some amounts of reserves to guarantee that you can make all these payments and avoid bank runs. So that's why liquidity management is not a trivial task. Notice, however, as we were discussing just a minute ago, a lot of the transactions that you and I carry out don't actually involve cash, right? Very often what we're doing is we're paying with debit cards, and when you pay something with a debit card, no cash is going anywhere. So the reserves are not entirely in the form of cash. Most of the reserves are in fact in the form of what's called a reserve account. And what are these? These are nothing more and nothing less than accounts that normal banks have at the Fed. And that's for convenience. So suppose I wrote you a $1,000 check. If we lived in a world with only cash, then at some point my bank would have to drive, and if you and I have different banks, then at some point my bank would have to put $1,000 in a truck and drive them across town to your bank so that they could get funds. Instead, what happens is that both our banks would have a reserve account. And then, in the instant in which, if I write you a check and you try and cash it, what happens is your bank calls my bank and says, there's this check here for $1,000, and my bank says, okay, so minus 1,000 in my reserve account, in that my bank's reserve account, and plus 1,000 at your bank's reserve account. So the reserves get to move between the banks electronically, as it were, by just moving them from one reserve account to the other at the Fed. No trucks need to drive any cash around in order for this to happen. So it's much more efficient. All right, so liquidity management is making sure you have enough reserves. The reserves literally are in two forms. One is cash, and the other is in the shape of funds, reserve accounts. Okay? Next, what I'd like to do is walk through a few examples of how liquidity management might actually take place. Examples of when a bank might need to actually rejiggle with its rejig its reserves. So to do that, I'd like to do the following. If you go to Blackboard and go over to exams, you'll see this item here, which says balance sheet worksheet. Now there are two of them. One has a Q and the other one doesn't. The one with the Q is the one with the questions, so please open that one. The other one has the answers and is for future reference. Okay, so let's open that. And when you open that worksheet, you should see something like this. Okay? So here are a few examples of things that might happen to a bank balance sheet. And here's a setup. There's a bank, let's say it's TD Bank. It has the following assets and liabilities: some securities, loans, checking deposits, and so on. So the first thing we want to do is set up this bank's balance sheet. So before looking at the numbers, you should be able to do this. Let's see, reserves go here, then loans, securities, sum total. And here we have deposits, we have borrowings, but if you look here, it says borrowings are zero, so let's forget it. Well, I guess we can put them there. Fine. And bank capital. And now that we've got everything straight, and remember, of course, in an exam question, you might be called upon to fill out a balance sheet. Now that we have things straight, let's plug in the numbers. So 108 in securities, next 100 million in loans, 220 in checking deposits, okay, the deposits, borrowings are zero, bank capital is B, and reserves are R. So far we're just trying to set things up. We haven't actually changed anything yet. There's no liquidity management problem yet. So A, if the bank's desired reserve or required reserve ratio, it doesn't matter if it's required or desired, the point is that it has to be there. If it's 10%, then what must be the reserves? Well, deposits are 220. 10% of 220 is 22. So now we know that R is 22. Next, it says sketch the bank's balance sheets. All right, we just did that. How much bank capital is there? Well, let's see. We haven't completed this thing. We don't know what bank capital is, but how can we figure that out? Well, we know that both sides of the balance sheet must be equal. And on the asset side, we actually already know everything. So we just need to add up to figure out what the total is. 100 plus 108 is 208, plus 22 is 230. So we know this is 230. It has the balance. 20 minus 230 is 10. So that's it. Now we know everything on the balance sheet. Now here comes the liquidity management part. Suppose the TD bank loses 20 million in checking deposits. What does that mean? It just means some customers came and took out 20 from the checking deposits. So this has to go down by 20. Of course, that means the total goes down by 20. That means this has to go down by 20. Then the question is, what happens? Obviously, if a total has gone down by 20, then one of these items has to change on the asset side. Now again, when someone pulls funds out of a bank, whether it's electronically or actual or from an ATM machine, it has to come out of the reserves. There's nowhere else it could immediately come out from. So, because that's the only thing the bank has that is usable as a means of payment by definition. So those are the changes that we're going to need to perform. So this is no longer 220, it's 200. This is not 230, it's 210 in here. And this is 22 minus 20, which is just 2. And then it says, what is the new reserve ratio? Well, the new reserve ratio is reserves divided by the deposits, and that's 1%. Notice that's a lot lower than the desired reserve ratio. Desired, required, doesn't really matter. The point is that, again, as discussed, the banks have a target reserve ratio that they need in order to make sure that their liquidity management is in order. Right now, they have less. There's list 4 categories on the balance sheet that the bank could adjust to make sure that it gets back to its desired or required reserve ratio. What do we need? Well, what is the required reserve rate? What is the desired amount of reserves? That's the first part here, right? Deposits are 2,000. The desired reserve ratio is 10%. So this bank wants or needs reserves of exactly 20. So somehow it has to get another 18. How can it do that? Well, as this question suggests, there are 4 ways of doing that, or 5 depending on how you count. Obviously, it has to do it by adjusting other items on its balance sheet. And I'll tell you the 4, but there are 2 of them that are going to be the main and most important ones. One way it could do it is by raising more capital, right? That's going to be rare. Another way it could do it is by what's called calling in loans. So most loans you can't do this, but there's some loans that the lender can demand to be paid in advance. That's going to be rare. The 2 more common ways of doing this are the following. One, remember there are these borrowings there. Why doesn't the bank just borrow from another bank or from the Fed? Then this wouldn't be 0, it would be 18. Then this wouldn't be 210, it would be 228. And of course, the reserves would now be up to 20. So that is a way in which banks can adjust their reserves. If they find they don't have enough, they can quickly run out and borrow from each other or from the Fed. That's one possibility. The other thing they could adjust here, we've already been through borrowings, bank capital, and loans, so the remaining one is securities. What could they do with their securities to raise money? They could sell them. And if you sell them, you sell 18 of them, 18 worth of them, then you have plus 18 in reserves and minus 18 in securities. So 2 plus 18 is 20. 108 minus 18 is 19. So these are the two main ways in which banks try to adjust their balance sheets to make sure they can quickly meet their target reserve ratio, selling securities or borrowing from each other. Okay? All right. That's the first part. The second part, here it says liquidity 2, starts off with the same bank. So I'm just going to paste its initial balance sheet there. We already figured out what the reserves are and what the bank capital is and so on. Now let's let the opposite happen. TD gains 20 in checking deposits. In other words, someone showed up and opened an account, or someone showed up and someone who was already a customer made a deposit. Maybe someone wrote them a check. So now we have plus 20 here. It says represent this change in a new balance sheet. Of course, that means the total has gone up by 20. This is kind of the opposite of what we looked at before. And in the instant in which the funds show up, the bank maybe would like to lend it out or maybe would like to do something with it, but in the instant in which those funds show up, they're reserves, right? So now we have, instead of 220, we have 240 here. The instant in which they show up, they're in reserves. So that's 42. And the total has gone up to 250. Okay. What is the new reserve ratio? The new reserve ratio is, the reserves are 42, the deposits are 240, and that should work out to 0.7175, which is 17.5%, which is a lot bigger than their target of 10%. In other words, they now have some reserves that they don't want. And it says list two different categories that you could adjust, because now we're focusing on the two common ones to make sure its target ratio returns, its reserve ratio returns to 10. So first of all, how much do they need? Or rather, how much extra do they have? In question, I guess. They have now 240 in deposits. So what they need or want is to get their reserves from 42 down to 240 times 10%, which is 4. In other words, they need to do something with these funds to reduce this by 18. 42 minus 18 equals 24. Now, before, the two common ways in which banks could do stuff to adjust their balance to get liquidity was by selling securities or borrowing. So in this case, the bank is in the opposite situation. It has too much reserves. So why doesn't it do the opposite? What is the opposite in this case? Well, before we had borrow 18, how about lend 18? The loans could go up by 18. Then this wouldn't be 42, it would be 42 minus 18, which is 24. And this would be 118 instead. And now the bank is back to its desired reserve ratio. Who would it lend to? Well, one possibility is that it could lend it to someone like you or me who's borrowing to finance their purchases or to take out a mortgage or whatever. Of course, finding a good customer like that may take time. What's a quicker and easier way of making loans? Well, how about the interbank loan market? Right? Every day, at the end of the day, some of the banks are finding themselves with too few reserves. Some of them have too many. And what do? The ones with too many can lend to each other, just like that, immediately, and get down to their target reserves. The ones that don't have enough, they can top up their reserves by borrowing. So it's like there's this fixed amount of reserves in total, and it's going around between the banks depending on who wants or needs it on any given day. So that was one possibility. The other one, buy securities. So instead of lending out these extra 18, I can just use them to buy bonds. And if I do that, same thing. I've now achieved my target reserve ratio. So 42 minus 18 is 24. And 108 plus 18 is 126. So either of those would be good. So again, the banks are experiencing these little liquidity shocks as people make deposits and so on, and then they adjust their balance sheets to make sure their reserve ratio is what they want, passing the reserves around the banks, depending on who needs them at any given point. Okay? Now, notice there's a third part here. There's a fourth, which is about bank capital, so you can have a look. It's related to what we did on Monday, so you can look at it if you wish. Liquidity 3 says a customer comes to the bank and asks for a loan. What balance sheet item must this come out from? So let's go back to the beginning and make a copy of the balance sheet's starting point. There. And what happens is someone like you or me comes up to the bank and says they want to take out a loan. They look us up and down and they say, oh, these people are associated with George Washington University. These people are great credit risk. Awesome. They want to borrow $1 million, I'll give them $1 million. So they would like to do this, to lend us funds so that we can go buy whatever it is. Where does that money have to come out of? Well, again, it has to come out of the reserves because those are the only liquid assets, or those are the only things that the bank has that it can use to make payments. So this has to go down to 21, and this would go up to 101. And notice, once again, this bank, just from its day-to-day lending activity, has found itself with insufficient reserves. It needs 22. It only has 21 because it just lent some to me. What can it do? Well, at this stage, it's now in the same situation as the bank in the liquidity 1 part, right? They just need to get one more in reserves. And how are they going to do that? Well, let's discuss. There are 4 ways, but the 2 main ones could either be that they borrow 1. Right? They want to add 1 to reserves. One way in which they could do it is by borrowing. which case their total assets have changed. Or what was the alternative? The alternative was to sell securities. Then this would be -1, this would be +1, and nothing else has changed. So again, for various reasons, because the deposits are moving around, because people withdraw cash, or because just the banks sometimes make loans, the amount of reserves they have are, keep fluctuating, and to try and keep them from doing that, the banks are constantly either borrowing and lending to each other, or buying and selling securities to each other. And so, again, there's a fixed amount of reserves. The banks don't control how much they are, but they're just passing them around to each other, right? If I need one in extra reserves, then I can borrow it from you. The total amount of reserves didn't change, just that you lend them to me. Or in this case, if I sell securities to you, you pay me out of your reserves. So again, the total amount of reserves has changed, but it's switching hands depending on the particular situation of each bank. Any questions or comments about this? Okay, so all of this begs a question. If there's a certain amount of reserves and the banks are passing the reserves among themselves based on who needs it, the question that raises is, where did all of those reserves come from? And what do you think the answer is? Let me write out a question. Oops. Where did the reserves? Remember, the reserves can be in two forms. They can be in the form of vault cash, or they can be in the form of reserve accounts. So where did all of that come from? Any ideas? The answer is a 3-letter answer. Or 6, I guess, depending on how it counts. The answer is the Fed. So ultimately, all these reserves, and actually, as we'll see, the cash itself, came from the Fed. The next obvious question is how? How did all those reserves and all that cash arrive at the banks? The answer is, well, consider that the Fed itself is a bank, right? So if the Fed, I mean, the Fed doesn't just print money and give it out to people. In the same way banks don't print deposits and give them out to people. The Fed, just like any other bank, has a balance sheet. And the way when it, let's say, decides it wants to increase the amount of cash in the world, it doesn't just print it and give it out. What it does is that it buys something. It pays for it with the new cash, and as soon as that happens, there's more cash in the world. Of course, since the Fed is a bank, the thing that it sells isn't goods and services. The things that it sells are financial assets. So the way the Fed affects what the reserves are and how much cash there is by buying or selling something. How does this work? Well, when the Fed buys something, naturally it has to pay for it, and it can pay in two ways, as discussed. One would be just to issue some new cash, right? Some new paper money. The other way, as discussed, we were saying that for the most part, banks' reserves are in the form of reserve accounts, not in the form of cash. So the other way the Fed could pay for it is just by saying, okay, I'm buying $100 million in bonds from JP Morgan, and I will just add 100 million to JP Morgan's reserve account with me. So the other way it can pay is by just adding to the reserve accounts. So that's how new reserves are created. The Fed decides that it's going to buy some assets. It has to pay for it with one of these two things. Either way, it's increasing the amount of reserves or cash that are out there. If you take all the cash in the reserve accounts and add them together, you end up with something called the monetary base. And so that's kind of how the banking system works here. The Fed generates a monetary base of a particular size by buying a certain amount of assets. Given that cash and those reserves, the banks and the people pass that around among themselves, but ultimately it's determined by the Fed. What if the Fed decided they wanted to decrease the monetary base or decrease the amount of reserves? Well, consider that when the Fed sells something, it has to get paid. With what? Well, if it sells something to a bank and the bank pays it with cash, well, that cash is no longer in circulation. It's gone. So the monetary base has declined. More likely, if the bank bought something from the Fed, it would just pay by having the amount subtracted from its reserve accounts. But either way, it required a decision by the Fed. So the Fed doesn't do anything. The monetary base and the total amount of reserves out there can't change. They can only change if and when the Fed decides to buy or sell something. Okay? Any questions, comments? And of course, given the importance of liquidity management for the bank's operation, and we're just seeing that they're ultimately passing around the reserves that the Fed has created, it means that the Fed maybe has a lot of influence on the lives of banks. We already saw that they lend to them sometimes with discount loans. The banks also have accounts of the Fed, the reserve accounts. Now we're seeing on top of it that the Fed controls how much reserves there are, and cash actually, for all the banks to hand around among themselves. That's a lot of control potentially. So we can be more specific, and instead of just talking abstractly about the Fed buying and selling assets and that creating the monetary base, I think it would be useful to actually see how this shows up on the balance sheet of the Fed itself. The Fed's a bank, so it has a balance sheet. And we'll see there's some ways in which its balance sheet is very normal and some ways in which it's a bit unusual. So if you think about, if you think about the following, maybe it's not so unusual, and that is the idea that just as you have a relationship with your bank, you are a client of the bank. Who are the Fed's clients? not individuals like you and me, but all the banks. So the things that show up on its balance sheet are going to be kind of similar conceptually to the things that show up on a bank's balance sheet, just that the clients are different. So let's look at the Fed's balance sheet. And remembering in the back of our minds that there is this thing that we're going to be looking for on the balance sheet that's called the monetary base. And what is the monetary base? Remember, it's what the Fed uses to pay for stuff, right? When they buy an asset, they have to pay with cash or reserves. So ultimately, that's what it is. The monetary base is what the Fed uses to pay for things. So liabilities, assets. And suppose the Fed goes out there and decides it's going to buy some bonds or some securities more broadly. The Fed, aside from government bonds and various bonds, the Fed actually has a lot of mortgage-backed securities on its balance sheet these days. If it's holding an asset, it has to have paid for something. And as discussed, the most common way in which it pays is by just increasing how much funds the seller has in their reserve account. And that sounds like a liability, right? When you or I have an account at a bank, those deposits are a liability of the bank. Who are the clients of the Fed? The banks. What is the name of the accounts that the banks have at the Fed? It's their reserve accounts. So the reserves, the funds in the reserves, are actually a liability of the Fed. Why? Because these are just accounts that the banks have at the Fed. So it's a liability the same way that my deposits at Wells Fargo are a liability of Wells Fargo. Remember, that's only one of the things in the monetary base. What's the other thing that the Fed could have paid, could have used to pay for some securities that it bought? They could have paid with cash, with new cash. And so another liability of the Fed is all the paper money. And if I'm not mistaken, the correct way to put that on the balance sheet is to call it Federal Reserve Notes Outstanding. And this is the monetary base. It's right there. It's on the Fed's balance sheet. These two things are liabilities of the Fed. And that's the key thing to have in mind at the moment. Any questions, comments? If not, then what I'll do next is just finish filling out this balance sheet, because of course this isn't the only things that are on the Fed balance sheet. By the way, this does address a question that came up over a month ago, which was, remember there was this discussion about money being backed by gold, at some point at least. Of course, now money isn't backed by gold. What is it backed by? Now, the answer for what is backing the money is what's on the asset side of the balance sheet. And one big part is just a bunch of securities, whatever it is that the Fed is holding, largely government debt, but also a lot of mortgage-backed securities and corporate debt as well. What else is on the asset side of the Fed balance sheet? Well, remember, the Fed sometimes makes loans to banks, so those discount loans are going to be here. What else have we discussed that that central banks might have as an asset? Remember when we were discussing international currency movements, we're discussing that central banks can try and actually affect exchange rates if they have some foreign currency. So the currency reserves, if they have any, are going to be there as well. And in addition, some other things like there is some gold there, in fact. But again, it would be inaccurate to say that the money is backed by gold because gold is a very small part of this. It's mainly securities. Deep down, the money that we use is backed by government debt, corporate debt, a bit of gold. Finally, if we want to be complete about what's on the Fed balance sheet, it's worth noting that the reserve accounts and the federal notes outstanding, strictly speaking, aren't the only liability of the Fed. There are other entities that have accounts at the Fed. Let's say the United States Treasury has an account there. Some states. It happens that central banks often have accounts with each other. The United Nations has an account with the Fed. So these are governmental or semi-governmental entities. They also may have an account with the Fed. And of course, the Fed has some bank capital as well. If the Fed has bank capital, it means it must have owners. Who are the owners of the Fed? All the banks. All the banks have to buy some of the shares of the Fed. So that's the Fed's balance sheet. And the key thing here is that everything that's in the monetary base is a liability of the Fed. And thus the Fed can control the monetary base. All it needs to do is buy or sell securities or make loans. Or buy and sell foreign currency, I guess, but that's not the main thing the Fed does. Okay, any questions, thoughts? So we've done quite a bit, actually. I think we're almost at a good point to stop. One thing I would like to do, actually, just before we end, is going to be mainly to tee up our discussion from the future, sorry, a discussion for next week. So let me see. By the way, I just noticed that I'd accidentally muted my computer, so I missed a couple of interventions from earlier. Sorry about that. Now I can hear you properly. The last note I wanted to make is that notice that although I'm saying that the Fed has ultimately perfect control over what the monetary base is, because it decides if and when to buy or sell anything, it is not true that the monetary base is identical to the money supply. That's important. And that'll be our topic for next week, trying to see in what way they're connected. The monetary base, as discussed, equals the funds in the reserve accounts plus the currency. What's the money supply? Well, I guess it depends if we're talking M1, M2, or M3, but broadly speaking, regardless of which measure we're using, money supply includes the currency, so that part is the same. But what's the other part of the money supply? If it's M1, we're talking checking accounts. If it's M2, we're talking checking, savings, and some CDs. M3, we're broadening the kinds of accounts that we're keeping in mind. In each case, regardless, the money supply is currency plus some sort of deposits. So the currency here corresponds to currency there. The question is there a link between the reserve accounts and the deposits? And if so, what is that link? Again, that's something that we'll probably spend a whole week discussing. But one way of seeing the link between reserve accounts and deposits is to look at where they show up on the balance sheets. Here are the deposits. And there's some other liabilities. And here are the reserves. And then there's some other assets. The key is that if this is D dollars in deposits and R dollars in reserves, on any bank balance sheet, you'll see that the reserves are some fraction of the deposits, possibly a very small fraction, right? And why is that? It's because whenever a bank gets funds, let's say someone opens a new account, in the instance in which those funds arrive, they are parked in reserves, but generally what the bank would like to do with the funds that it has is use them to make loans or to buy securities, not to have them sitting around in reserves. So this proportion here may be quite small. So on any bank balance sheet, you're going to find that the reserves are much smaller than the deposits. What that tells you is that the money supply is probably bigger than the monetary base. And why is it bigger? And to what extent is it bigger? Well, intuitively here, and again, we're going to go over this more carefully later, the reason that the reserves on any bank balance sheet are so much smaller than the deposits is because banks use funds to lend out, either directly through loans or by buying securities. So what that tells us is that the money supply is equal to the monetary base times a number we're going to call the multiplier, which we're going to study next week. And the size of this multiplier depends on what? Well, it depends on how enthusiastic the banks are about lending out. If they lend out most of the funds that they receive, then this number will be small relative to that. And the multiplier will be large. On the other hand, if they don't want to lend, and any new funds that they receive, they just keep as deposits, then this multiplier won't be very large. All right? So the monetary base is not the money supply, although there's a sense at which it's at the root of the money supply, as the name suggests. The money supply is going to be larger in general, and next time we'll have a look at what are the factors that cause. Okay? Questions, comments? Ready, steady, go. True or false? Reserve accounts are a liability of the Fed. It is true. Remember, they're right there on the balance sheet. Next question. True or false? Paper money is a liability of the Fed. Mm-hmm. 10 seconds. It is. Remember, it's also right there on the balance sheets. Federal Reserve notes outstanding. In the instance in which I withdraw money from my bank, what happens on its balance sheet? Which one of these is correct? Someone's thinking long and hard about this one. Oh, you all got it right. Excellent. Good job. Next, if the bank has insufficient reserves, what can it do? Sell securities, buy securities, decrease its borrowings, or pay dividends? All right, most of you got that right. Very good. 5 of 8. If a regular bank buys bonds from another bank, the monetary base rises. True or false? It is false. And the next question is going to hopefully explain why. If a central bank buys bonds from a regular bank, the monetary base rises. True or false? It is true. Indeed. 7 of 8. The total amount of reserves is mainly controlled by the Fed. True or false? It is true. That's right. And last, when the central bank buys bonds, generally what happens? For this, use your demand and supply intuition, or your prior macro knowledge. Either one will do. Interest rates fall. When the Fed buys bonds, they're increasing the monetary base, and as we'll see next week, that makes interest rates go down. So, third place was Eamon. Nice work. Second place is Marshall. And who is first? CJ. Okay. All right, CJ. Good work. So, what do you want me to do with Snapchat today?
Hi, Professor. I think if you could just wear a crown, that would be good.
A crown. Let's see. No results. Let's try king. How about this one? Let's see if it works.
That is beautiful.
All right. Great. Thanks very much, everyone. I hope everyone is well. Stay in touch. Write if you need anything, and if not, we'll see each other next week.
Thank you, Professor.
Thank you. Take care.